In this video, I explain stock options to regular people. Let's get started. But before we talk about stock options, let's talk about the stock market. And even if you know, please stick with me here for a split second. This will be very short. I need to make an analogy that will put us all on the same page. So what is the stock market? The stock market is really like any other market. So like a farmer's market, for example, where sellers offer to sell things and buyers are looking to buy something. But obviously it's a virtual market, and there are several slight differences. First of all, you can put buy offers, or what's called in search of offers. Also, there are thousands of buy and sell offers available constantly. Whenever there's a buy and sell pair which coincides, the transaction goes through. So if someone wants to sell 100 shares of Apple for $200 and someone wants to buy 100 shares of Apple for $200, the shares will trade hands. In general, when there are more buyers, which means more demand, prices go up. When there are more sellers, which means more supply, prices go down. And this is obvious. The stock market is a free market with prices dictated by supply and demand. So how do you make money in the stock market? You make money in the stock market the same way you make money anywhere else. You buy low, you sell high. You buy a surfboard for $200, you sell it for $300. You buy a stock for $100, you sell it for $200. For the stock market, there are two successful strategies. Hold for the long term, because over time the stock market goes up, where the key word here is long term. There are many times when the stock market goes down, but if you look at it periods of time 5, 10, 20 years and up, over those lengths of time, the market goes up. And it can go up significantly, historically at a rate of 5 to 10% a year over 20 years. The other way to make money is if you can predict the future. So if you know a certain stock is going to go up, you can buy it, wait for it to go up, and then sell it. The problem with these strategies is that, first of all, we don't necessarily always have long term. You may want to make money over the next 3 to 5 years and not just over the next 20 years. And even if you do have 20 years, depending on your entry point, if you invest right before a significant market downturn versus right after, the amount of money you make can vary significantly, often by 5 to 10 times or more. And that's 5 to 10 times, not 5 to 10%. And let's look at some examples. This is the last 6 years of the NASDAQ. If you had invested in January 2022 at a value of $16,000, first of all, you would have had to hold through a downturn from 16,000 to 11,000, which is a 30% drop. And only 2 years later, you would have broken even. Now that we're up above 21,000, so up just about 33% from where you got in, which is around 10% gains per year. And that's actually not bad at all. But if you had invested in January 2023 instead of 2022 at a value of 11,000, you would now be up almost 100% because we're up at almost 22,000 and in less time, so in under 2 years. So 3 times the difference in less time. And that's just an example from the last 3 years. Let's take a step back. This is the last 25 years of the NASDAQ. What you see at the beginning in the year 2000 is the dot-com bubble. 2008 over here is the financial crisis. They look tiny, don't they? And just as an anecdote, that's why many people are hesitant to invest in the current market, because holy shit, it's so high, right? No one wants to start investing right before the market goes down, and at the same time, everyone is convinced we are right before a market downturn. And that makes sense because it's easy to see that if you invested in 2000, you lost more than half of your money in the following 3 years, and only broke even 14 years later. It then took another 5 years to double. So overall 19 years to double, whereas if you invested in 2003 at a value of around 1,000, by 2019, when the market was up at 8,000, you had an 8 times. And that's the difference between investing 50,000 and ending with 100,000, so doubling, or investing 50,000 and ending with 400,000. It's a very big difference. And about predicting the future, despite all the analysts and economists spending their life reading, analyzing, predicting, statistics show that timing the market isn't usually successful. So what else can we do? And here's where we get the topic of this presentation, stock options. And I want to go back to the Facebook Marketplace analogy. Let's say I like surfing. I found the surfboard I like on Facebook Marketplace. The person wants to sell it for $750. Brand new, it costs $1,000. Some people will drive over and buy it, save the 25% and go surf. But I'm Israeli, and ask any Israeli. Any real Israeli knows we always want a discount. We'll always bargain. Hey man, what'll you give it to me for? Will you take $500? Okay, 550 is my highest price. No? Okay, I'll tell you what. I'm willing to buy it for $600 anytime in the next 2 weeks, but that's the highest I'll go. If you wanted to sell it for $600, I'll take it. Otherwise, no deal. What I just did is I gave him an option. I'm giving him the option to sell me the surfboard for $600 anytime in the next 2 weeks. The offer has three properties. The object, in this case it's a surfboard, the price, and the duration it's available for. Because if he doesn't want to sell in the next 2 weeks, I'll probably go buy a different surfboard because I want to go surfing and I want a board already. It sounds simple and understandable, doesn't it? So options on the stock market work the same way, except for one tiny difference. Because on the stock market, we're trying to make money and not waste it on toys. The option I just gave, when you're trying to make money, you don't give anything for free, you sell it. Because if someone will take something from you, it's worth money. So instead of giving him a free offer, hey, if you want to sell for $600, give me a call. On the stock market, it goes like, hey, if you give me $50 right now, I promise to buy the surfboard off you for $600 anytime in the next 2 weeks. You decide if you want to sell me the surfboard anytime during those 2 weeks, but the $50 you give me right now, and I keep it either way, whether you decide to sell me the board or not. The stronger mathematicians among us will immediately realize that I'm no longer purchasing the board for $600. It's really only $550, because even if he decides to sell me the board for $600, he already paid me $50 for the option. And if the next day someone else offers to buy the board for the original $750 he's asking, it's my loss because I didn't get the board I wanted, but I still keep the $50. And that's actually how stock options work. It really is, I promise. People are willing to pay for the option to sell you a stock for a certain price for a certain duration. But let's jump back to the surfboard example so we remain in a situation we're all familiar with and can easily understand. Let's say I sold the person the option to buy his surfboard for $600. He paid me $50, but luckily for him, he got another offer for the surfboard for $750. Sold to the other person, the $50 he gave me expired. He didn't sell me the surfboard, he had already sold it to someone else. You can kind of see how this is a win-win. I made $50 for promising to buy the surfboard for a price I thought was good. The seller sold his surfboard for $750 minus the $50 he paid me, but still $700 is more than the $600 he was going to get if he did end up selling me the board, and someone else bought a surfboard they wanted. On the one hand, it's a bummer for me because I didn't get the surfboard I wanted. But if in the first place I didn't really want the surfboard, I was browsing Facebook Marketplace and trying to make money, I had a win, right? I made $50 for offering to buy a surfboard I wanted anyway, for a price I was willing to pay. I didn't end up getting the board, but I still kept the money. On the other hand, if I wanted to make $50 by buying and selling regular products on Facebook Marketplace, I would have needed to buy the surfboard for $750 and then turn around and sell it to some other sucker for $800. But maybe no one wanted to buy it for $800. So I ended up needing to sell the board 2 months later to someone who offered me $700, and I ended up losing $50 overall. Or maybe someone was willing to buy it for $750 and I came out even. But I wasted 2 months of my life and countless is this available messages and wasted time. This is one simple example how you can make money in the stock market by using options. Because options on stock work exactly the same way as the Facebook Marketplace analogy. Obviously, the prices are different and the products bought and sold are stocks. But other than that, the mechanics are exactly the same. Someone will pay me money for the option to sell 100 shares of Apple for $200 at any time in the next 2 weeks, or the next 2 months, or the next 2 years. And the price is also flexible, so I can sell the option for $200 or 190 or 180 or 150. And they pay the money up front and I keep it, whether they end up selling me the shares or not. How much money do they pay? It depends. Depends on the current price of Apple, depends on the volatility of Apple over time, depends on various parameters. And why would they pay me money to do that? For many reasons, which I'll explain in a different presentation, but they will. And how much money exactly can easily be checked at any given time. So why is this awesome? This is awesome because we no longer need to see the future in order to make money. Time only goes forward. So if we sell something which has a time limit, once the time has passed, we keep the money. If we sold a 2-week option, after 2 weeks, the option is over, or in technical terms, it expired, and we can sell another option. So options give us the ability to sell time, which we know for a fact will run out. In addition to having certainty about time running out, options also enable us to make money even if the stock price stays the same or goes down. And on top of all that, we don't need to actually buy the stock. We can sell options which have a high probability of expiring without ever needing to buy the stock. Don't believe me? Let's have a look. Tesla. Who hasn't heard of the company and their wild ride of a launch way back in 2003? With their stock currently trading at $350, this is the graph of the better part of the past year. You can see a couple of things. First of all, that it was better to have bought them a year ago, right? It actually would have been awesome if you bought them in March for around $175. You would have doubled your money in under a year. Too bad we can't go back in time, right? But where is it going to go from here? It's on the way up for sure, but it's already up from 250 to 350, which is 40% just in the last month. Will it go up another 40% next month? I don't know. It seems unlikely. But even if it does, will it go up another 40% the month after? That's already quite unlikely, but again, who knows? Maybe it'll go back down to 250, just like it was earlier this month. And this is the problem with trying to predict the future. Let's take a step back. This is the last 3 years of Tesla. What we saw in the previous slide was just this last bit where the stock went up from 175 to 350. But now we can see that if you had bought the stock in February 2022 for 350 and held until now, you actually didn't make any money. And in fact, you wasted 2 years of your life while your money took a vacation. It didn't work at all. More than that, if you had bought in February 22 for 350 and 4 months later Tesla had dropped to 220, you actually lost just about 40% of your money. And you were probably stressed about it. And maybe you even sold the shares, in which case literally 40% of your savings evaporated. When Tesla popped back towards $300, if you sold before, you were probably kicking yourself. Maybe you bought back in, maybe you didn't. Either way, another 50% drop was ahead. And if you didn't sell in June, I sure hope you didn't sell in December, January, because that would have been really bad. Either way, it's easy to see how timing the market, or in this case a specific stock, is a fool's errand. But for the sake of learning, let's take another step back. So here we get even more evidence which supports some of the ideas we talked about before. Investing for the long term is a good way to make money, but you really need to be in it for the long term. 2 to 3 years isn't always enough, as we saw before, and here we see more evidence of that. If you bought Tesla in 2014 over here and held for 3, 4, or even 5 years, even if you didn't lose money, you didn't make very much money either. Hindsight 2020, there are many points you could have bought shares of Tesla and made a ton of money if you knew what would happen. But just like now, we don't know if Tesla will go up from where it is right now at 350 towards 400 and more. Also in January 2022, when Tesla was at 350, we didn't know if it was going to go up towards $400. And as it turned out, it went down more than 50% in 2022 and took a full 3 years to recover back to its January 22 levels. And that's why investing in stocks is so risky and controversial, because you can make and lose fortunes in extremely short times. But options get rid of the decision fatigue of what to buy, when to buy, how long to hold, when to sell, what to buy after you sold. And in fact, this whole lesson is about options, not stocks. So how do we use them? Let's have a look. With Tesla presently at 350, we don't know whether it'll go up or down or sideways from here. I do know that 2 weeks from now will come in 2 weeks. So let's offer the option for someone to sell me 100 shares of Tesla anytime in the next 2 weeks for $340. How much will someone pay me for that option? So this is an actual market order, and the answer is $9.3 or $932 for 100 shares. That's what someone will give me to promise to buy 100 shares of Tesla for $10 less than they are today. Said another way, for the option to sell 100 shares of Tesla at 340. Let's check some other options. So this is another market order, which shows someone will pay me basically $600 to promise to buy 100 shares of Tesla for $20 less than they are today. So I adjusted the price. And then as long as Tesla stays above $330, I keep the $600 and I can do the same thing again in 2 weeks. Or if you're worried Tesla may go down even more, someone will pay me $200 for the option to sell 100 shares of Tesla for $310, more than 10% less than what it is today, for 2 weeks, not even a month. But we can also do longer options. Let's have a look at 2 months. Remember that $310 2-week option someone was willing to give us $200 for? The same price, but 2 months out, someone will give us $16 or $1,630 for 100 shares. So as long as Tesla doesn't go down more than 10%, I keep $1,600 and can do the same thing again in 2 months. Now keep in mind, if Tesla does go down to $300 in the next 2 months, I will need to buy the shares for $310. But let's play it out. In 2 months, the option we sold will expire, and Tesla will either be above $310 or below. Let's talk about possible outcomes. Let's say the best case scenario is Tesla goes up another 40% from 350, which is 490, but let's round it to $500 for easy calculations. And then the worst case we'll talk about is if Tesla goes down 40% from where it is now, which is just about $200. If we had bought the stock, the calculation is very simple. $150 profit times 100 shares is $15,000 profit for the best case scenario, or $15,000 loss for the worst case scenario. If we had sold the option, the outcomes are quite different. If Tesla went up $40, the option expired worthless, and we keep the $1,600, and that's our profit. In the worst case scenario, we are forced to buy the shares for $310, times 100 shares is $31,000, minus the $1,600 we originally got for the option, so it's like we paid $29,400 for the shares. With shares currently trading at $200 times 100 shares, it's $20,000, so we have a $9,400 loss. Or more concisely, it's a $1,600 profit for the options versus $15,000 profit for the stock in the best case. And in the worst case, it's a $9,400 loss compared to a $15,000 loss for the stock. You might think that doesn't look too appealing. We're severely limiting our profit in the best case while still losing a lot of money in the worst case. But let's zoom in a little bit because our best and worst case scenarios are quite extreme. This is a chart of the possible outcomes by $50 jumps, where the current price is bolded at 350. So if we're considering 7 possible outcomes, if we buy the shares, we only profit in 3 out of 7 of the possible outcomes. So we have less than a 50% chance of profit. Versus for the options trade, we profit in 5 out of 7 of the possible outcomes. So 71% chance of any profit. And yes, the profit is smaller, but even 1,600 divided by 29,400 is 5.4% over 2 months. So 32% over the year. or annualized to use the technical term. And gains of 32% a year is actually amazing. Warren Buffett, arguably the most famous investor of all time, whose net worth is currently 150 billion, attained his legendary status by generating average returns of only 22%. A 30% return means you will double your money every 2.5 years. So if you start now with just $1,000 and double every 2.5 years, after 20 years, you'll have $250,000. And then 10 years after that, or overall 30 years from when you started, you'll have $4 million. So even though in the best case scenario I missed out on a lot of potential profits, the fact that I have a 4 out of 7 chance, which is a 57% chance of making 32% annualized returns, and a 71% chance of making any profit at all, is a trade-off you may be willing to take. And that's the downside of this options strategy, that your best case is making only 30% annualized. Whereas if the stock goes up more than 30% annualized, you make less money. But again, you don't lose money. You only make less money. And that's a huge difference. This strategy focuses on capital preservation rather than potential outsized returns, because chasing greater than 30% returns is a great way to lose all of your money. And on top of the improved risk reward profile, there's another advantage to selling the option. If you started out with 35,000 and were forced to buy the shares for 29,400, you still have $5,600 left over. And let's say the worst case scenario happened. Tesla dropped 40% and it's trading at $200. You can use your remaining $5,600 to buy an additional 28 shares at $200, which lowers your cost of entry even further. So 35,000 divided by 128 shares is 273. So it's like you paid $273. And if we recall the graph of Tesla we saw earlier, it's easy to see that while we still don't know if Tesla will go up or down from $200, historically speaking, over the last 3 years, $200 was a great price to buy Tesla. Said another way, over most of the last 3 years, Tesla was trading above $200. So it seems like a good idea to buy another 28 shares. But if you're still worried about the worst case scenario, the 310 price that we sold the option for is also flexible. We can sell an option for whatever price we want. We previously explored the 310 options, but for a $300 option, someone will pay us $1,300. Or for a $270 option, someone will pay us $640. And let's think about this. $270 is 23% less than the share price today. So someone is paying you to buy shares of Tesla for 23% less than they are today. Recalling back the surfboard analogy, if you wanted to buy the surfboard and the person suddenly lowered the price by 20%, you would probably think that's a good time to buy, right? Because if you don't, someone else probably will, and then you won't get to surf. So same with a stock. If you wanted to buy Tesla and Tesla was trading at 350, and you waited and watched, and over the next month it went down to $270, that would be a great opportunity to buy Tesla. A month ago it was 350, now it's 270. Definitely a better time to buy. But we can also go farther. That 2-month, $300 option someone was willing to pay $1,300 for, if you give them 2 years instead of 2 months, they will pay $6,700. $6,700 to buy shares of Tesla for 15% lower than they are today. Plus, they're paying $67, so you're really only buying the shares for $300 minus 67, so $233, which is 33% lower than it is today. And we can also go lower. Someone will pay $44 or $4,400 for 100 shares for the option to sell at 250. And the danger of longer options is obviously that it gives the possibility of more unknown. So while it's unlikely that Tesla will drop 50% tomorrow, the possibility that it will drop 50% over the next 2 weeks is higher, 2 months is higher still, and 2 years obviously more. But the longer duration options give you way more money up front and also give time for the stock to recover. For example, if we look back to the 3-year graph of Tesla, If we had sold the $250 two-year option in October 2022, so right over here, and just waited, even though Tesla went as low as $120 in January 2023, come October 24, Tesla was already back to 250. And we can go as low as we want. Someone will pay $2,560 for the option to sell at $200. And even $1,200, so almost 280, so almost $1,300 for the option to sell at $150. So almost 60% lower than what Tesla is trading at today. So what do we get from all this? First of all, that you can make money by promising to buy a stock. You get paid upfront, and you possibly don't even need to buy the stock. In the best case scenario, you get to keep the money and you can sell another promise. And while we don't know if a stock will go up or down, we do know that the time will eventually run out. And that gives us a statistical edge compared to buying stocks. And this statistical edge, while it doesn't promise success or profits 100% of the time, it's akin to a casino. The house doesn't win every game. There are people who profit gambling, but over many people and a long time, the house always wins. So we want to be the house. The option we've been speaking about up till now, which gives someone the right to sell a stock for a set price for a set duration, is called a put option. And options can be bought and sold at any time, i.e., if you sold a 2-year put option for $5,000, you don't necessarily need to wait for the whole 2 years to be over. If a year has passed, there only remains a year of option left, and assuming the stock is at a similar price to where it was a year ago, probably the option is now only worth half of that, so $2,500. You can then buy back the option for $2,500 and you keep the $2,500 difference as profit. And a couple of other things. We only touched on one type of option, the put option. There's a whole other type of option which we won't get into in this presentation, but it's something to keep in mind. Other than that, and this is more advanced stuff, but options can be combined, i.e., you can buy and sell different options at the same time. Again, we won't touch this topic in this presentation. It's just something to keep in mind that this is the tip of the iceberg. For example, the options strategy we discussed in the presentation, which prioritizes capital preservation at the expense of high profits, is called a cash secured put. There are countless other options strategies, both simple and more complicated, which enable different risk-reward profiles, each with different levels of probability of success. We can also build an option strategy which limits your downside risk, but maximizes potential profit. The trade-off in that case is obviously it will have a lower probability of success, so not suitable for everyone. And that's why it's so important to consider your investment goals when building your investment strategy, and choose strategies that will give you a high probability of attaining your goals. So this was a very short introduction to options investing, designed only to demonstrate a tiny bit about how it's possible to use time and probability to help make consistent income from your savings. From here on, there are infinite resources to learn from, but it's hard to transition from really any amount of theoretical knowledge to actually investing your hard-earned cash. And that's why here at Beyond Stocks Options Investing Academy, our flagship service is our one-on-one mentoring program, where I hold your hand from wherever you are on your investment journey, as long as you need, until you feel comfortable proceeding alone. And this could be from the very beginning of opening a brokerage account and enabling options trading, or for someone who is already investing, to go over your existing portfolio and optimize profits while minimizing risk. So here you are. You took your first step in learning how to make your money work for you in a consistent and responsible way. The next step is up to you. And I'll end this presentation with this disclaimer that this presentation is for informational purposes only and is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state.